My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. People make friends. I'm just trying to make a little money. My job, not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Let the bad times roll. What can I say? When Salesforce lays off 8,000 people, or 10% of its staff, and the stock rockets higher, you have the blueprint for a tech turnaround. Given the tech's been an ongoing disaster, a millstone around the neck of the market. More than 3% gain in Salesforce in the wake of that news today confirms that even software as a service stocks can rally. A charge of approximately $1.4 billion to $2.1 billion led to a nearly $5 billion gain in market capitalization for the Cloud King. Yes, and I think that the Cloud King's move is just beginning.
House of pleasure.
That's one of the reasons why the things were fine with the Dow ultimately up 133 points, S&P advancing 0.75%, NASDAQ climbing up 6.9%, despite some downbeat comments from the Fed in month-old meetings that inflation is still raging. Salesforce CEO Mark Benioff didn't mince words in his letter to employees. Quote, the environment remains challenging and our customers are taking a more measured approach to their purchasing decisions. With this in mind, we've made a very difficult decision to reduce our workforce by about 10%, mostly over the coming weeks, end quote. Wow. It's Mark Benioff. The overexpansion was their own doing. As he articulates, quote, I've been thinking a lot about how we came to this moment. As our revenue accelerated through the pandemic, we hired too many people leading into this economic downturn that we're now facing. And I take responsibility for that, end quote. Tough and good. All right, this isn't the first time layoffs have propelled big cap techs higher. Meta Platforms, for instance, chopped 13% of its workforce on November 9th when the stock was at 96. Now it's at 127. Again, too many people, too few revenues. This was Mark Benioff. Now, I'm not saying that we're going to cost cut our way out of this remorseless market. That doesn't work. If businesses keep cutting back on marketing, Salesforce will have to fire more people. Perhaps prodded maybe by this Starboard Value, the activist firm that's encouraging tough Ohana love that has a lot of shares. If Mark Zuckerberg, founder and CEO of Meta Platforms, can't figure out how to monetize the metaverse, doesn't spend more time on Reels, his version of TikTok, then he's going to need to let a lot more people go, along with a lot of real estate. But at the end of the day, this market has become unforgiving to the fat, happy tech companies that hired too many people during the pandemic and are now seeing that they're not taking the tough actions needed to protect you, the shareholder. The kind of actions that a steelmaker or a chemical company will do reflexively going into a downturn. They know how to do it. The tech guys, they've never seen anything like this. They don't know what to do. Which brings me to why we see this happening. We've discovered that the mega cap techs, the giants that in some cases got trillion-dollar valuations or multi-trillion dollars, because precisely they did that because we thought there was no cyclicality. And now they're wallowing in cyclical hell. We used to think they could keep growing like crazy regardless of the underlying economy. But that is no longer the case, which is why they can stand to benefit from so many cost cuts, as painful as they are.
House of Pain.
Can you imagine how much Alphabet would jump if they admitted that they, too, had overhired during the pandemic? When you were sitting at home with nothing to do, you watch YouTube and you look things up at Google. When you had to go back to work every day, your habits changed. But did Alphabet do anything when that business slowed? Oh, yeah, they did. How about this? How about they announced a mega plan for $9.5 billion in offices, data centers, and hiring 12,000 new people. Very expensive people. I kid you not. That's what they did. That's what they did. It's time for Alphabet to bite the bullet, admit that all three moves were wrong, and start the layoffs. We never want to root for people to lose their jobs. But the market's going to keep punishing them until that happens. A year ago, during the tail end of the pandemic, Amazon had 1.1 million employees in the U.S. Well, that's about as many as we have in the armed forces. How many of these people does it need now? The same amount? Do you think that Amazon needs as many workers as it did when we were hunkered down, waiting for our boxes, waiting for our Amazon deliveries? It's not just retail Amazon, for heaven's sake, that's undersold. Its web service business is also slowing, according to some analysts. So again, if there are too many people, they need to let some people go. Even if their sales stay the same, the earnings can still grow as long as they find ways to cut costs. And that would be enough to make this market happy, and their stocks would fly. Oh, I was thinking today how much Amazon would be up, how much Alphabet would be up if they just did the right thing. And the right thing sometimes is a hurtful thing. After listening to a powerful downgrade this morning of Microsoft because of slowing Azure cloud sales, I figure they also have too many data centers, too many people, too many unknown projects that turn out to have cyclical components, more hostage to the business cycle than we thought, for certain. Time to pay more attention to the bottom line than to the eco line. Apple. All right, well, this one's a little tougher. I know that Apple's been the most hesitant about hiring among the mega caps anyway. It probably doesn't have as much overhead as the others. That said, with the stock down to the point where the market capitalization is almost down $1 trillion from the high, pretty much a free fall, by the way, this would be a good time to rationalize their cost structure if they want to do it. What's happening here? Why am I discussing these mega cap tech companies like they're Caterpillar or Cleveland Cliffs or Union Pacific or American Airlines? Because that's what they've become. In the old days, these companies always seemed like they would grow endlessly to the sky, no matter what you said about them. It always felt like their business was only in the second inning. There was very little competition. For the most part, it was secular growth with nobody going against them. A remarkable thing. No competitors, moats all over the place, untethered from the underlying economy. Well, now we are well past the seventh inning, and for some of them, the growth ballgame is over. For a full decade, these companies defied all criticism, but as we got to 2020, we began to see that there was indeed some cyclicality. We know that because they have customers, actual paying customers. And you know what happens to customers? Sometimes when there's a downturn, they don't have the money to pay. They can't handle a downturn. They spend less when the economy's weaker. That's what customers do, whether you like it or not. I bet if you were at Amazon right now, you might be saying, hey, maybe we don't need all those Rivian trucks. Maybe we have too many data centers. Maybe we need to raise the price of Amazon Prime while letting some people go because business is slowing. I am sure CEO Andy Jassy is thinking the same thing. Do we really need all this real estate? Do we really need all these people? Do we really need all these data centers? Do we really need all these warehouses? Endless. There are so many tech companies that bloated payrolls that are still trying to grow rapidly, overpaying for new employees, and they fear that layoffs will mean that their time in the sun is over and Wall Street won't like it. But they don't seem to understand that their time in the sun ended over a year ago when the Fed started getting tough on inflation. I saw the same thing happen during the dot-com collapse. Back then, the ones that didn't cut costs, that didn't care about preserving the institution, the ones that didn't want the institution to be preserved, well, guess what? They closed. More than 330 of them. Only a couple made it. I'm saying that this decline will be as bad as the 2000 and 2001. Won't be that. Nor am I saying that tech stocks can rally endlessly on cost cuts, especially when the newly released Fed minutes from last month show that our central bank doesn't want the stock market getting ahead of itself. But let's face it, there are gluts in tech everywhere. It's just that nobody in tech wants to admit it. So just keep these words in mind from Mark Benioff's letter this morning. As one Ohana over the last 23 years, Salesforce has built the #1 CRM, customer management, that drives incredible customer success across every line of business for every industry around the world. End quote. Ohana means family. If Mark Benioff, the originator of the Ohana, can cut family, so can anyone else. Bottom line, once these tech guys are willing to fire family, you know they've adjusted to the new, much more hostile reality. But there's a lot of family out there, and a lot of that family has to find a new family or go to a new home because they're about to get disowned. Yvonne in Florida. Yvonne.
Happy New Year, Jim.
Same to you, Yvonne. What's going on?
Yeah, calling about your thoughts on Devon Energy. Is it a good time to buy? And if it is, how long would you hold Devon?
I think it's an excellent time to buy. We had Carly Garner's work on yesterday. She's a fantastic technician. Told you to sell oil at 120. She says it's time to buy now. The stock's at 58. I think you want to buy. It's the right time. And don't forget, you got that 9% yield. All right, look, once these tech guys are willing to fire family, you know they've adjusted to the new, much more hostile reality. But how many have done that? Well, Mad Money tonight, we cover the top performers in the Dow, and tonight we're focusing on the S&P 500 to see which of last year's big winners can repeat their performance in 2023. Then, have the earnings estimates come down enough to have a sustainable bottom in this market? I'll give you my take. And could some of the beaten down names in the S&P prove to be strong buying opportunities going into the new year? I'm revealing 5 stocks I have on my radar that you must hear about, that I'm sure you don't even like. Until you hear more, stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.